It's March 2020. The market just dropped 34% in 33 days. You've been watching your retirement account fall every single day for a month. Your $200,000 is now $132,000 on your screen. And something in your brain says, do something, get out, stop the bleeding. That instinct, the one that feels like the only rational response, is the most expensive one in personal finance. Today, I'm going to show you exactly what happened to the people who followed that instinct and exactly what structure would have protected you from ever having to make that decision. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Today, we're covering 4 things: the documented emotional cycle every investor goes through during a crash, the specific dollar cost of the most common mistake, why your information environment is designed to make that mistake worse, and the 3 structural tools that protect your wealth, not by predicting the market, but by making sure you never become a forced seller. There's a cycle every investor goes through during a crash. It's not personality. It's not a character flaw. It's documented, it's predictable, and it has 5 stages. Stage 1 is denial, days 1 through 7. The narrative in your head is, this is temporary. The market overreacted. This will bounce back next week. Stage 2 is fear. Weeks 2 and 3. The drop continues. Now the narrative shifts to catastrophe. You start refreshing your account multiple times in a day. Stage 3 is panic. And panic has a very specific voice. It says, get me out. I can't watch this. This is the stage where the decision happens. Stage 4 is regret. Months 2 through 5. The recovery has begun, but you're watching it from the sidelines. In cash, watching the markets climb without you. Stage 5 is resolve, full recovery. You tell yourself, I'll never do that again. And then the next crash comes, and you do. Here's what makes this cycle so dangerous. In 2020, it played out on an exact calendar. February 19th was the peak. The S&P 500 closed at 3,386. March 23rd was the bottom, 2,237. August 18th was full recovery, 3,389. From peak to full recovery, 6 months. But the panic stage, stage 3, happened in the 3rd week of March, right at the bottom. Now, here's what nobody tells you about market crashes. This cycle has repeated without exception across every major market decline in 100 years. Let me walk you through 4 of them. 1987, Black Monday. The Dow dropped 22.6% in one single day. Still the largest one-day percentage decline in history. Full recovery? Less than 2 years. 2000, the dot-com crash. The S&P 500 dropped 49% over 2.5 years. This one hurt for longer. Full recovery took about 7 years. 2008, the global financial crisis. The S&P 500 dropped 57% over 17 months. Full recovery took about 5.5 years. 2020, COVID. A 34% drop in 33 days. The fastest crash from the peak in history. Full recovery, 5 months. Different causes, different speeds, different durations, same outcome. The markets recovered every single time. Here's the line I want you to remember. The market has a 100% recovery rate. Investor behavior doesn't. That gap between what the market does and what investors do, that gap is where wealth is destroyed. Let me make this concrete. Imagine you have $200,000 invested on February 19th, 2020. By the bottom, March 22nd, your account shows $132,000. You panic, you sell, you move everything to money market fund. You feel relief. The bleeding stops. 5 months later, August 18th, the market recovers to its pre-crash high. Your friend who didn't sell is back to $200,000. You're still at $132,000. So you wait. You want to be sure it's really recovered. But the market keeps climbing. Each rally feels like a trap, like the top right before another crash. So you stay in cash. By late 2021, about 18 months after the bottom, the state portfolio is worth approximately $268,000. You're still at $132,000. The cost of that one decision to sell at the bottom was approximately $136,000 on every $200,000 invested. And here's the part that makes it land. That gap, $136,000, is roughly the same amount you have left. You didn't lose your money once, you lost it twice. Once on paper when the market dropped, and again in opportunity when you locked in the loss. This is not a hypothetical. This is what behavioral research firm Dauber has documented year after year. A persistent gap between what the market returns and what the average investor actually earns. And in 2020 specifically, this happened to millions of people. According to data from the Investment Company Institute, United States, investors pulled $348 billion out of stock, bond, and hybrid mutual funds in March 2020 alone. Not a typo. $348 billion locked in at or near the bottom. Now I want to pause because I can feel some of you thinking, I wouldn't have done that. I would have stayed in. Maybe you're right. But here's what the data says. In every market crash, more investors sell than buy. Because the decision isn't made in the abstract. It's made at 11 p.m. when the news is running a special on the global financial collapse. The decision that costs $136,000 doesn't feel like a financial decision in the moment. It feels like the only sensible thing to do. That's the part I want you to understand. If this is resonating, subscribe before we go further. I post every week on exactly this kind of evidence-based financial strategy for Canadian investors. Okay, back to it. Why is panic selling so universal? Two mechanisms, both well documented. The first is loss aversion. Daniel Kahneman and Amos Tversky won a Nobel Prize for this work. What they found is that the pain of losing $50,000 is psychologically about twice as powerful as the pleasure of gaining $50,000. So the pain you feel watching your portfolio drop is not proportional to the dollar amount. It's amplified, about double. The second is the amygdala stress response. This is a part of your brain that handles danger in our revolutionary past. And here's the problem. It cannot distinguish between a financial threat and a physical one. The same flight or fight response that protects you from a bear in the woods fires when you watch your portfolio fall. Doing something is the amygdala's solution to every threat. So your brain, designed beautifully for the savannah, is processing a numerical value on a screen as if a predator is in the room. And the instinct to act is strongest at exactly the moment when acting is most expensive. This is not weakness, it's biology. Knowing that doesn't make it go away, but it changes what you do about it. Now, Layer on top of that biology your information environment. Your information environment is not neutral. It is actively calibrated to maximize your emotional response because emotional response drives engagement. During the 2020 crash, financial headlines were dominated by language like collapse, destruction, worst since. Coverage of the recovery, a small fraction of the volume. Researchers at Columbia Business School documented this directly. A negative feedback loop between news coverage and market volatility that ran from January through March of 2020. Financial media coverage during downturns isn't just informing you, it's shaping the mental backdrop you make decisions against. Negative framing generates roughly 3 times more engagement than neutral framing. The business model of financial news is not to inform you, it's to keep you watching. And fear keeps you watching longer. So you have a brain wired to overreact, listening to a media environment that profits from amplification, watching a screen that updates by the second. That's the architecture. Now let's break it. Everything I've covered so far applies to every investor. But I want you to spend the next few minutes on something that applies specifically to people within 10 years of retirement. Because the stakes are categorically different. This is the part most financial YouTube never addresses. And it's the most expensive gap in retirement planning. Here's a thought experiment. 2 investors retire with identical $600,000 portfolios. Same average annual return over the next 25 years, 6%. Same withdrawal rate, $30,000 per year. The only difference between them is when the good and bad years happen. Investor A retires and eats a 35% crash in year 1. Then the market recovers. Investor B retires and the same crash hits, but in year 20. Investor A runs out of money at age 79. Investor B dies with $1.2 million. Same average return, same withdrawal rate, a 23-year gap in outcomes based entirely on the sequence. This is called sequence of returns risk. It's the single most important concept in retirement planning that most people learn too late. The reason a crash matters so much in early retirement is that you're not just sitting through it. You're selling shares while it's down to fund your living expenses. Every share you sell at the bottom is a share that cannot participate in the recovery. Once it's gone, it's gone. A crash in years 1 to 5 of retirement is categorically different than the same crash at age 42. Now, connect this back to crash behavior. The reason a 35% drop is dangerous in early retirement is that you become what's called a forced seller. Your portfolio drops 35% in year 1 of retirement, and you're withdrawing $30,000 to live on. You are forced to sell shares at the bottom, not because you panicked, but because you needed groceries and a roof. Every share sold at the bottom is a share that cannot recover. The structural solution is straightforward: a cash buffer. 1 to 2 years of living expenses held in a high interest savings account or a short-term GIC kept separate from your investment portfolio. That money exists for one job: to make sure that during a crash, you're never a forced seller. You wait. The market recovers. Your equity portfolio never gets touched at the bottom. This is not a complicated tool. It is a deeply unsexy one, and it's one of the highest impact decisions in retirement planning. Here's the truth about everything I've described today. The solution to all of it is not being braver or calmer or more disciplined than you were in 2020. The solution is structure. Structure that works when your discipline fails, because it will. Everyone's does. So here's what the structure looks like. 3 steps. Each one solves a specific problem. Step 1, a cash buffer. 1 to 2 years of living expenses held in a high interest savings account or short-term GIC, kept separate from your investment portfolio. This is not your emergency fund. This is your behavioral buffer. Calculate your number. If your annual expenses are $60,000, your buffer is $60,000 to $120,000 in cash. With that in place, you're never a forced seller during a crash. Step 2, automatic contributions. Continue investing on a fixed schedule regardless of market conditions. Dollar cost averaging means that when the market drops, you're buying more shares at lower prices. The 2020 crash was a sale. The investors who kept contributing through it bought the entire recovery at a discount. $500 a month continued through the 2020 bottom versus past. That single difference, by the end of 2021, was about $14,200 in additional wealth from contributions alone before compounding. Step 3, an investment policy statement. This is a 1-page document you write when you're calm that specifies your allocation, when you will and won't rebalance, and what would have to be true for you to change your strategy. Your 2019 self knew exactly what to do. Your March 23rd, 2020 self needed a document to remind them. That document, written in advance, is worth $136,000. If you've sold during a crash before, I need you to hear this without any judgment. You didn't fail. You responded exactly the way your brain is designed to respond to a perceived threat. Every financial planner I know has clients who sold in 2020. Some of them are financial planners themselves. The goal isn't to be the person who never feels the urge. The goal is to build a structure so the urge doesn't become a $136,000 decision. This week, one thing, calculate your behavioral buffer. What would 12 months of your living expenses look like in a separate account? That's your first step. If you want the next layer, how to build that cash buffer using high interest savings and short-term GICs without losing ground to inflation, I covered that in the next video. Subscribe, and I'll see you in the next video.